In 1790, the United States debt stood at $70 million. By 1980, that had grown to $1 trillion. It took 220 years for the United States debt to reach $1 trillion of debt. Since then, it has taken 40 years, one generation, for debt to go from $1 trillion to $35 trillion. And the pace seems to be accelerating. Over the last year alone, we've seen United States debt go up by $3 trillion. What once took 220 years to happen today happens 3 times in a single year. Not only has debt been expanding very rapidly, but the economy has struggled to keep up with these rising levels of debt. The United States gross domestic product that you see here became smaller than the entire debt load in 2015. That was barely 10 years ago. And since then, we've seen debt grow much more rapidly than the United States economy. Today, the total size of the US economy is currently around $28 trillion, while the size of US debt stands at a staggering $35 trillion. That means debt today in the United States is around 120% larger than the size of the US economy. This is a ratio called the debt to GDP ratio, and today it's hovering at the highest levels we've seen over the last 50 years. And according to the government's own predictions, these debt levels are going to go substantially higher over the next couple of decades. That's got to be a bad thing, right? Well, if we look at the stock market over the last 50 years, it doesn't really seem like they care about the fact that debt to GDP has been rising. In fact, arguably, the stock market performed much better between 2010 and today when debt levels were very elevated than, for example, during the 1970s when debt levels were still very low. So should stock market investors just not care about debt? Or is there going to be some day of reckoning where at one point debt levels get too high for the economy and financial markets to handle and we see financial markets come crashing down? Well, academic studies do suggest that higher levels of debt directly translate into a slower economy. When debt to GDP is below 30%, generally you can expect around a 4% real GDP growth. That means the economy is growing at 4% adjusted for inflation, which is a really rapid rate of growth. As we go up in debt levels, we see that's usually associated with lower economic growth. When debt to GDP is above 90%, which is currently the case for the United States economy, we see that growth averages below 2%. So half as much as when debt levels are low. This is from an academic paper that took a look at 20 developed economies going back all the way to 1790 using more than 200 years of data. And their conclusion is clear. Higher debt levels lead to lower economic growth, although you probably don't need to be a PhD economist to come up with that same conclusion. Long-term economic growth in the United States has been on a steady decline since the 1970s. This is a chart showing the average 20-year economic growth that the United States has had, adjusted for inflation. In the 1970s, the United States economy grew at a rate of 4% per year. Today, we're averaging around a 2% growth adjusted for inflation. Much less impressive. When we add the United States debt load on top of this chart, we can see that debt has been rising while economic growth has been declining. If I inverse economic growth, we can see it's almost a perfect match. As the United States debt load has been rising, economic growth in the US has slowed down considerably. Of course, it's debatable whether a slowing economy has been the cause for rising debt levels in the United States or whether rising debt levels have caused the economy to slow down. The truth is, there's probably a little bit of both that's happening. What's clear is that if the government's own projections regarding debt are true, that's really not a good sign for economic growth looking forward. So why is the stock market trading just a few percentage points below its all-time high? Does economic growth not matter to investors? Well, kind of. When we look at the stock market's valuation, it's sitting at one of the highest levels of the last 50 years. This is using something called the Shiller PE ratio, and it basically tells us how expensive the stock market is over time. And today it's pretty darn expensive. One of the things that has been driving these elevated valuations has been falling interest rates in the United States over the last 40 years. In the 1960s and 70s, for example, rising interest rates led stock market valuations lower. When interest rates peaked, valuations bottomed, and as interest rates fell, valuations expanded. And that makes sense. When interest rates go up, investors can get a better return by just being invested in bonds. And so that pushes down the value of the stock market. When interest rates go down, investors are going to look for more risk in other assets, and that's going to push the valuation of the stock market higher. In fact, when we flip this chart of valuations, we see there's a very close relationship between interest rates and the valuation of the stock market. Of course, the relationship is far from perfect. Like here, valuations were very elevated relative to interest rates. That was a result of the tech bubble in the late 1990s. Or here, valuations were very low relative to interest rates. That was a result of the financial crisis that made investors hate stocks. It took over a decade for valuations to once again reflect the reality of interest rates. Now, today with interest rates at 4.6%, those are not particularly worrying levels for stock market valuations. But anything above a 5% interest rate tends to be a bad thing for valuations. For example, historically, when interest rates are at 7%, well, typically that's been associated with a PE ratio between around 17 and 10. Currently, the PE ratio stands at a massive 32. So hypothetically, if interest rates were to rise another 2%, the stock market could correct by as much as 50%. And that's where high levels of debt over the coming years could become an issue for the stock market's valuation. According to studies from various independent institutions, a rising debt to GDP directly translates into higher interest rates. Investors ask for a higher interest rate when they think there's more risk. According to these studies, a 1% increase in a nation's debt to GDP equates to around a 0.04% increase in interest rates. Now, that may not sound like much, but the government's own calculations suggest that debt to GDP could rise by another 50% over the next 10-15 years. If that proves to be the case, that would translate into a 2% increase in long-term interest rates. That could take interest rates to around 7% over the next 10-15 years, and that could lead to a very violent correction in the stock market's valuation. Just over the last couple of weeks, we've seen interest rates rise from 4% to 4.6%, and that immediately caused an almost 10% correction on the stock market. Imagine what would happen to stocks if interest rates rose much more substantially. But all of that is very long-term stuff. It's likely that's going to be the trend over the next 10-15 years. When we zoom in on the most recent developments on interest rates, they have been rising recently, but not because of government debt. This is a result of oil that has been spiking recently. When oil rises, it directly leads to higher levels of inflation. Electricity prices are a function of oil. Food prices at the supermarket that require transportation go up when oil prices are higher. People ask for higher wages when it gets more expensive to fill up their car at the gas pump. And so that's what's been happening over the last few months. Oil prices have led to rising interest rates and so leading the stock market lower. But you can see more recently we've seen oil prices reverse. And that could be hinting that interest rates are about to reverse as well. That's exactly what happened back in October. Right here, oil reversed just a month before interest rates reversed as well. That is our base case for this correction on the S&P 500. Ever since we called for this correction to occur, we said it would be driven by higher interest rates, but that it would likely be limited to around a 5-6% drawdown. The reason for that is because of this technical structure that you see right here, and the S&P 500 has so far held that level and bounced right off. We sent out a memo early last week to our members right after the initial move up in the market, highlighting that we could see some additional volatility in the stock market over the next couple of weeks that would allow us to accumulate some parts of the market that we think are attractive today and could still have quite a bit of upside in the short term. Don't forget, you can try our service out completely for free at gameoftrades.net.